Good afternoon and welcome back to the Camarda Wealth Channel. I am your host, Troy Lerche, bringing you this week in wealth. I wanted to, first of all, wish everybody a happy 4th of July. I hope everybody had a great long weekend. I know I feel rested and great to be back in the office. I also wanted to let you guys know that we took a break last week. We were letting the second quarter finish up and the month of June, everything kind of play out, and then getting ready to get back to work and start doing the videos again. As you know, we always start with our CAPE indicator. Our CAPE indicator is now at 38.21, which if you remember from previous videos, we were at about 37.5, or last week it was 37.92. So it's even higher as the market finished up last week. Our bull bear indicator is still in cyclical bull territory, and we have all 4 of our indicators. 4 out of 4 are positive. In the U.S. markets, the S&P 500 index and technology-heavy NASDAQ composite moved to all-time highs and closed out a 5th consecutive quarter advance last week. The Dow Jones Industrial Average finished 353 points up, finishing the week at 34,786, which was a gain of approximately 1%. And the NASDAQ likewise finished up the week about 1.9%. And by market cap, we had the large caps finishing up 1.7, while mid cap and small cap retreated by 0.6% and 1.2% respectively. In the international markets, we had developed international markets declining by 0.8% and emerging markets falling by 1.3%. For commodities, we had precious metals finish the week to the upside, with gold rising 0.3% and silver adding 1.6%. Oil had its 6th consecutive week of positive closing finishes, which finished up the week 1.5% at 75.16 per barrel for West Texas Intermediate crude. And copper, an industrial metal, ended up the week down 0.4%. So now I'm going to talk about June and the quarter 2 summary a little bit. In the US, the NASDAQ led the way in June, which was up 5.5%, followed by the S&P 500 up 2.2%, and the Russell 2000 up 1.9%. The Dow and mid caps finished the month down 0.1% and 1.1% respectively. In the second quarter, the NASDAQ led the pack with a gain of 9.5%, and the Dow rose 4.6%, while large caps rallied 8.2%, mid caps and small caps tacked on a little bit smaller amount, 3.3% and 4.1%. In the international June and quarter 2 summary, we had Canada and European stocks were the best international performers for June. Canada rose 1.6% and the UK gained 0.2%. France added 0.4% and Germany ticked up 0.1%. China retreated by 0.3% and the Nikkei in Japan pulled back 1.2%. Emerging markets as a group finished the month flat, while developed markets ended the month down 1.3%. In the second quarter, Canada rose 7.8%, the UK gained 4.8%, France rallied 7.3%, Germany added 3.5%, China rose 4.3%, while Japan actually declined 1.3%. Emerging markets added 3.1%, and while developed international markets added 4.1% for the quarter. I know that was a lot. I do apologize for some of these summaries, but we want to make sure we cover what June happened and the quarter 2 summary. So next, we're going to talk about commodities. We have the June was not a very good month for precious metals. Gold and silver retreated 7% and 6.5% respectively. But June was good for oil, which rallied 10.8% for the month. Copper finished the month down 8.3%, and for the quarter, gold gained 3.1%, silver added 6.8%, copper rose 7.4%, while oil beat them all with a whopping 24.2% gain. In U.S. economic news, we had the number of Americans filing for first-time unemployment benefits sank to a pandemic low as extra benefits began to phase out. The Labor Department reported new applications for unemployment fell by 51,000 last week for new pandemic lows of 364,000, which is further evidence that the rapid economic rebound from because of more aggressive efforts by companies to hire new workers. The decline in new claims was bigger than expected, and the enhanced federal benefits due to the coronavirus are set to expire in September. So we're watching that closely as well to see what happens in the retail environment or with the workforce. The U.S. added the most new jobs in almost a year in June as the economy perked up and companies rushed to hire more workers. The Bureau of Labor Statistics reported that U.S. created 850,000 new jobs last year, or created 850,000 new jobs. Economists had only forecasted 706,000. Most of the new jobs, as we've talked about, were in service-oriented positions as restaurants, hotels, and retailers. But government payrolls did increase by 188,000, but that was largely a result of the pandemic-related efforts on education. Unemployment rate, meanwhile, rose slightly to 5.9% from 5.8%. Despite the robust economic recovery and record number of job openings, unemployment remains quite high. Some 26 states will stop giving out extra federal benefits of up to $300 a week in early July in an effort to nudge people back to work. Now we talk about real estate, one of the hottest things, the hottest topics around the market. The National Association of Realtors reported that pending home sales rose 8% in May, well above the consensus of a decline of 1%. So that was a difference of 9% off of forecasts. So that's pretty big. Compared to the same time last year, pending home sales were up 13.1%. But at the same time last year, home sales activity had fallen amid the onset of the COVID-19 pandemic. In the report, all regions saw an uptick in sales, led by 15.5% surge in the Northeast, and the South saw the smallest increase with just a 4.9% uptick. Home prices rose at their fastest pace on record in April, according to the latest data from S&P CoreLogic. The S&P Case-Shiller's National Home Price Index increased 14.6% over the past year, the highest year-over-year reading in more than 30 years of data. As in recent months, Phoenix, San Diego, and Seattle experienced the largest gains over the past year, with home prices in all three cities rising approximately 20% from last April. That is crazy. Manufacturing, a survey of U.S. manufacturing slipped in May. According to the Institute of Supply Management, or ISM, the ISM reported manufacturing activity dropped to 60.6 in June from 61.2 in May. Businesses are still struggling to cope with the broad shortage of key supplies and skilled labor as customers' demand for their goods soared above pre-pandemic levels. Although readings above 60 are considered exceptional, companies still had lots of concerns as orders continue to roll in and they're not able to meet the demand. The survey highlighted the prices for many materials have risen sharply and products aren't getting delivered on time. And in some cases, companies simply lack enough labor to make as much has been ordered. Across the Atlantic, the Bank of England's outgoing chief economist warned that inflation could rise by more than expected and force the central bank into a dangerous, quote, handbrake turn to stop the economy from overheating. He expected the surge in consumer prices would drive UK inflation closer to 4% this year. Finally, what if a large factor in current worker shortage is unexpected high retirement? Oxford economics and capital economics analysts have highlighted a huge jump in recent baby boomer retirements, each one of which is another worker removed from the country's workforce. Michael Pierce of Capital Economic writes, quote, that is equivalent to 2 million workers, which would explain more than half of the current shortfall in the labor force. Bob Schwartz of Oxford Economics notes that, quote, older households hold more wealth than younger ones, and the improved balance sheets of senior workers may well have tipped them over into retirement. So we'll be monitoring that. That could come into play with the massive wealth transfer and the overall shortage of labor. So that's all for today. I hope everyone again had a safe and happy 4th of July, and we'll talk to you soon. Take care.